In today's video, I'm going to talk about 3 things every beginner investor should know before they purchase a house for investment purposes. Before we get to the list, as always, you can skip to a summary of the list at the end of this video. You'll see the timestamp on the screen. And lastly, as always, please subscribe, comment, rate, and review. Your support means a lot. Your feedback means a lot, even if it's negative. I always appreciate honest feedback. So let's get on with the list. Number 3, in most cases, the rental income, specifically speaking about Toronto and other really hot real estate markets, will not make you a big profit. If you're lucky, it will make you a small, negligible profit, but at best and most likely scenario, it's going to help you break even on the mortgage, the condominium fees if it's a condo, and other fees associated with ownership. So we're also obviously talking about taxes and insurance and all that. The rental income is just going to help you break even. Now, obviously, this depends on a multitude of factors: what kind of rate you get on your mortgage, and how much you pay for a condo fee if it's a condo, the property taxes, how much you put down. I'm not saying in every situation you're gonna only break even. However, for beginner investors who want to purchase a house, you're most likely only gonna break even on the rental income. And that's not necessarily a bad thing, because this leads us into number 2. Number 2, the bulk of your return on investment is going to come from the proceeds of sale. So when you sell the investment property. So let's harken back to number 3 for a second. I said at best for a beginner investor, you're going to break even. Well, that's not the worst thing in the world, because you're basically breaking even on the costs of ownership while the property appreciates, assuming the property does appreciate in this market. And once you sell it, once again, depending on multiple factors, but for the purpose of this video, let's say in 3 years or 4 years, then you get the proceeds of sale, which are derived from the appreciation. And you've basically made a profit once you sold it. The rental income just helped you stay afloat while the property appreciated, and you sold it and you got the proceeds. So you could easily sum up number 2 as your return of investment will come from the appreciation of the property and the proceeds once you dispose of the property, not so much the rental income. This might be obvious to you, but you know, not a lot of people are as knowledgeable as you, maybe. Most people think rental income is passive income, and thus, you know, it's a good thing. They're gonna make a profit, they're gonna get the $200, $300 a month. Number 1, the first thing I think beginner home investors should know before they purchase their first property for investment purposes. So once you do sell the property you've purchased for investment purposes, it's appreciated. Let's say you bought it at $500,000. Now you've sold it at $650,000, $700,000, whatever the figures are. The profit you make, once again, assuming everything else is equal for the purposes of this example, you have to pay taxes on the proceeds. Now, this might seem obvious to some, but a lot of investors don't think about this. When you buy stocks and they go up in value, and you then sell your stocks and you make a profit, you have to pay a capital gains tax on the stocks. The same thing applies to rental properties or investment properties. Once you've sold your property and is deemed by the government to be a investment property, you have to pay a capital gains tax. Now, how much this capital gains tax is depends on a multitude of factors. For instance, your annual income besides the profit you will make from the disposition of the property, how long you've held this rental property for, investment property, how much you sold it for, so on and so forth. But you can range it anywhere between 15 to 30%, I would assume. So essentially, on the profit, hopefully you would make on your rental property, once you've sold it, you would have to calculate away about 15 to 30% of it. Once again, this is a general range. It depends on a multitude of factors, but you have to calculate basically a deduction of 30% in some cases. All right, so here is the summary of the list. Number 3, rental income in most cases and in hot markets like Toronto will only help you break even on ownership of the investment property, most likely. Number 2, the return on investment is not the rental income, it's the proceeds of sale once you've sold this property. Number 3, if your rental property or investment property is deemed as such, an investment property, then you have to pay a capital gains tax to the government, which can range from 15 to 30% depending on a multitude of factors, such as your annual income for that year, how much and how long have you held this property for, and so on and so forth. As always, this is Sam from Saberisix Real Estate. Please comment, rate, and review, subscribe. And yes, I will make more in-depth videos for investors in the future, but I thought I would make a generalized video right now. And yeah, there you have it. So as always, stay in touch. Thank you.